If you're retiring soon and want to be smart about where you're getting your income, you have to be careful about 3 key income limits so you can keep as much of your income as absolutely possible. When you retire, you might have a whole bunch of different options for where you can make withdrawals and get your income. You might be able to pull from an IRA, a Roth, a 401k, or other retirement plan. Maybe you can start Social Security, use dividends or interest, sell investments, or use cash, or one of many other options. Because there's so many options, it may be really hard to know which combination is best for you. At the end of the day, we want to make sure that you're being smart and intentional with where you get your income so you don't inadvertently trip over one of these really important income limits and cause yourself either more tax or more expense. So let's dive in. When we help clients figure out where to get their income in early retirement, we pay attention to 3 key limits of income to make sure that they're keeping as much of their money as absolutely possible. The first income limit that we're looking at is for those folks who are not yet 65 and they need to buy health insurance from a healthcare marketplace. So we're thinking about how much they're paying and how we can get them to qualify for premium credits, which reduce their costs. The more income we have on our tax return, the less credits we receive, which means higher health insurance costs, which can mean tens of thousands of dollars more in premiums, which we obviously don't want. So we have to be really careful with where we're getting our income so we can have as low of income on our tax return as possible and get as much of those credits as we can qualify for. Income limit number 2 has to do with Medicare, specifically Medicare Part B and D. This is often referred to as IRMA. When your income goes over certain limits, you pay more premium for Medicare Part B and D. So we want to make sure that we know if we're close to going over those limits so we can be really careful to not inadvertently go over and cost ourselves more Medicare premium than we really should be paying. Number 3, this is the big one that applies to the most folks, and that's making sure that we understand how much income we can have on our tax return and stay within our target tax bracket. A lot of folks in retirement are trying to stay in a low tax bracket for obvious reasons, but we have to be careful that our income sources aren't pushing us up into a higher bracket. This is especially true for folks who are trying to implement strategies like Roth conversions, where we want to pay as low of a rate on our Roth conversion as absolutely possible, or if we are going to live off of selling investments and avoiding capital gains tax in a low tax bracket. We have to be really careful about how much income we have to show on our return so we stay in that low bracket. It's very easy to lose track of that, file your return and realize that you're in a higher bracket than you thought you were, and that can be really disruptive to your tax strategy. So those are the 3 limits that we're really being careful about in early retirement. And really it comes down to having control and being intentional over how much income shows up on your tax return. Luckily, we have a lot of control over that, and if we're strategic and look ahead far enough, we can be really careful and make sure that we're not paying more health insurance premiums than we should, or Medicare insurance premiums than we should, or we're not causing us to bump up into a higher tax bracket and pay more tax than we should. Once we have a good idea of whether any of those income limits actually applies to us and how they impact us, we can start making decisions about where to get our retirement income.